Hi, I'm Florida foreclosure defense attorney Richard Shuster, and today's topic is streamlined loan modifications. Starting July 1st, 2013, Fannie Mae and Freddie Mac rolled out streamlined loan modifications, the greatest change in the loan modification programs since the start of HAMP. HAMP is still going to be around, the traditional loan modification still exists, but a streamlined loan modification is the default go-to option for Fannie Mae and Freddie Mac. People ask, how is a streamlined modification different from a traditional modification? Well, the biggest difference between the two is how you apply for it. Fannie Mae and Freddie Mac realized that the paperwork requirements, the documentation required for a traditional HAMP modification, it was just too complicated for the banks to work with. And most of the people who wanted a HAMP loan modification didn't get one. And the number one reason for people being turned down for a HAMP was an incomplete file. There's even been allegations that people at Bank of America and other banks would throw part of the paperwork away and have people submit documents over and over and over again because it was just easier for the banks to say that the application was incomplete than to do the hard work of underwriting the application. So Fannie Mae and Freddie Mac wanted a loan modification which had easy paperwork requirements. The next big difference between a traditional loan modification and a streamlined loan modification is the mechanics of what you get if you're approved. The traditional loan modification reduces the consumer's payment by reducing their interest rate. And how the test goes is they keep lowering the interest rate in whole numbers, 1%, 2%, 3% drops until they get to 2%. And they're lowering the interest rate to get the interest rate and the homeowner's payment under 31% of their income. If all they got to do is lower your interest rate from 5% to 4% to get the person's monthly payment under 31% of their income, at that point they stop. But if they get to 2% and the homeowner's payment is still more than 31% of their income, they say, you know what, you fail on the income level. If we drop you down to 2% and your housing cost is still more than 31% of what you earn, you do not qualify, you do not make enough money. Under the streamlined modification, the way that the payment is reduced is they take a significant chunk of the upside down balance and they put that in a non-interest bearing balloon. The non-interest bearing balloon means that, for example, if you owe $200,000 and your house is worth $100,000, the bank might put $50,000 or $60,000 of your loan balance and put it in a balloon, meaning you're only going to pay interest on the $150,000, and the $50,000 that's in the non-interest bearing balloon, you're not going to make any payments on that. The benefit is that if you're only paying interest on $150,000 instead of $200,000, your payment's going to go down. The other thing a streamlined modification is going to do is they're going to lower your interest rate to current market rates, which for most people is 4 or 4.5%. Your interest rate probably will not go down as far as it would in HAMP, but the combination of lowering the interest rate and having you pay interest on a smaller portion of your loan balance, those two things combined should reduce your payment quite a bit. The eligibility requirements for a streamlined mod are broader than those for HAMP. To be eligible for a streamlined mod, you need to be 90 to 720 days delinquent. What does that mean? Well, it means that if you're current on your loan, you're not going to get a streamlined mod. And if you've missed more than 2 years of payments, you're more than 720 days delinquent, and you will not be getting a streamlined mod. The second eligibility requirement is that your loan-to-value ratio has to be greater than 80%. People ask, what's a loan-to-value ratio? Well, that's fancy bank speak for a fraction. And that fraction has in the numerator on the top half the amount that's owed. And in the bottom half of that fraction is the value of the property. So if you owe $100,000 and the value of your property is $200,000, your fraction is going to be 50%, and you are not going to be eligible. Why? Because if your property is worth $200,000 and you only owe $100,000, Fannie Mae and Freddie Mac figure foreclose on the property. We'll get all of our principal back. But if you're upside down or you are flat, or even if you have just a tiny bit of equity, your loan-to-value ratio is going to be more than 80% and you'll qualify under this prong. The third requirement is an easy one. It has to be your first mortgage. So to recap, if you are not 3 months to 2 years delinquent, you're underwater a ton or a little, or you're flat, or even if you have a tiny bit of equity and it's your first mortgage, you should qualify for this program. If you are behind on your mortgage and the lender calls you and you're 90 days to 720 days delinquent, ask them about a Streamlined mod. If a foreclosure action has already been filed against you and you want to keep your house, we will steer you in that direction if it makes financial sense for you. If you have other questions about Streamlined modifications, feel free to call us, send us an email, or visit our blog. I'm Richard Shuster. Thanks for watching.